Banks have been pushing hard for a cashless society, encouraging people to use digital payments instead of physical money. While going digital offers convenience, it also gives banks and financial institutions more control over transactions. Ever wondered why banks dislike cash so much? Here are the top 10 reasons why banks want you to ditch physical money and go fully digital. 1. Cash transactions are hard to track. When you use cash, the transaction is private and leaves no digital footprint. Banks and governments prefer digital transactions because they can be tracked, recorded, and analyzed. This allows them to monitor spending habits, enforce tax laws, and control financial activities more effectively. 2. Banks can't make money from cash. When you keep cash in your wallet instead of depositing it in a bank, the bank can't use it. Banks profit by lending out deposits at higher interest rates than they pay customers. The more cash you hold, the less money banks have to lend and make a profit from. 3. Digital transactions generate fees. Every time you swipe a credit or debit card, banks and payment processors take a cut through transaction fees. Whether it's a small business accepting card payments or a customer paying bills online, banks make money on every digital transaction. With cash, there are no such fees, which is why banks prefer digital payments. 4. Cash withdrawals are costly for banks. Maintaining ATMs, securing cash deliveries, and handling physical money costs banks a lot of money. By reducing the use of cash, banks can save on these operational expenses. A digital economy means fewer ATMs, lower cash handling costs, and higher profits for financial institutions. 5. Digital money makes it easier to charge negative interest. In a cashless society, banks can charge negative interest rates, meaning they take money from your savings instead of paying you interest. With cash, people can simply withdraw their money and avoid this, but with digital-only banking, there's no escape from negative rates. 6. Digital payments encourage more spending. Studies show that people spend more when using cards or mobile payments compared to cash. Digital transactions make spending feel less real, leading to higher consumption and more profit for banks through transaction fees and interest on credit card balances. 7. Cash reduces government and bank control. With cash, individuals have full control over their money. In a digital system, banks and governments can freeze accounts, impose limits on transactions, or even devalue currency through policies. A cashless society gives financial institutions more control over people's access to money. 8. Digital payments make debt more attractive. When money is digital, borrowing becomes easier. Credit cards, personal loans, and buy now pay later services are all digital products that encourage people to take on more debt. The more people borrow, the more banks earn from interest payments. 9. Digital transactions allow more data collection. Every digital payment you make generates data about your spending habits. Banks, payment processors, and even third-party companies analyze this data to sell financial products, target ads, or even make lending decisions based on your financial behavior. 10. A cashless society makes banking mandatory. If cash disappears completely, everyone will be forced to rely on banks to store and access their money. This gives banks complete control over financial transactions, making it nearly impossible to operate outside the banking system. While digital payments offer convenience, they also come with risks, including less financial privacy and increased control by banks and governments. Holding some cash as a backup and understanding how digital finance works can help you maintain financial independence in an increasingly cashless world.